Hi, welcome to our Revsim hotel simulation. This is our management team composed of 5 members, Jenny, Alex, Thibaut, Augustin and myself. The Fasanoh Hotel is a 4-star hotel city center, waterfront property with 250 rooms. The past 2 years, performances were not up to standards, and this is why this year we have decided to implement a whole new strategy. We decided to target leisure travelers because the Tourism Authority and Hotel Association have joined resources to triple the regional promotional budget for leisure travelers according to the owner's briefing. Plus, this market segment spends money on ancillary services and therefore will generate revenue for our hotel. Secondly, we will also target small and larger groups, and this is why we need very good meeting room facilities amongst others. In addition, we bet on the market penetration pricing, with low prices and then raise them up slowly as we invest in facilities. Last year, our occupancy was higher during weekdays than during the weekends. Therefore, our prices are slightly higher during weekdays than weekends in order to generate revenue during weekdays and to raise our occupancy during the weekends thanks to lower prices. We can see that we have an average total occupancy throughout the year of 66.5%, which is better than the 54% we had last year. Secondly, we can see in the table that our market share is better during the first quarter, given the competitive prices we have applied at the beginning of the year. However, we can see a slight decline after our first quarter as we have raised our prices. Our RevPAR during the third quarter of $148 is due to high revenue generating during the high season, and we also have a very good occupancy rate of 73.8%. We have good guest evaluations regarding our meeting rooms, which is good as we target groups who need these facilities. In order to analyze our revenue and profit during the year, during the first quarter, we generated almost no profit because of our low prices. However, starting from March, we started generating enough profit, and we can see that it kept increasing until August. Then, given that we have raised our prices in September, we consequently faced a 9% decrease in occupancy, and logically, our revenue and profit began to drop.
Regarding our market index, we can see in the graph a boost in our ADR and RevPAR indexes as we have increased our prices in March to compensate from the investment we had done in facilities. Thus, our occupancy index decreased at the same time. After the first quarter, our RevPAR index remained above the average throughout the whole year, while our ADR dropped below the average during the third quarter, as well as the occupancy index. From there on, both began to rise again. We will explain further why our indexes had such a trend. Overall, thanks to our facilities and fair prices in line with the quality of our hotel, the Fasanoh Hotel managed to be one of the best hotels in terms of quality and prices.
Concerning pricing, we decided to start with an average bar standard rate of $160 and agreed to increase it up to $190 at the end of the quarter. We wanted to keep low competitive prices as to capture most of the Trojan market. Concerning investment, our strategy was to save our initial budget to start investing at the end of the quarter. During the third months, we have invested more than $500,000 in a new restaurant and new meeting rooms. That's why we increased the price from $160 to $190. Concerning the marketing expenses, we decided to increase our marketing expenses toward the quarter in order to promote the several investments that we had made. Actually, we decided to double our expenses at the end of the period, started from $15,000 to $37,000. Not to invest during the 2 first months, we kept low prices in order to penetrate the market. Our quarterly average occupancy rate was about 61%, when the one of our comp set was about 54%. Indeed, this strategy led us to an average of our occupancy index of 1.13. Our marketing strategy was quite accurate with our investment strategy. Besides, as we had the lowest prices, we did not need to spend that much money in marketing since low prices are already attractive. However, we miscalculated the rates we should apply, which led us to a poor RevPAR index. Concerning pricing, at the beginning of the quarter, we did not change our rates. We then increased them up to $210 in order to increase our AGI index. In the end of the quarter, we decreased our fares down to $200 as of trying to capture most of the market share. Concerning investing, we spent a total of $33,500 in refurbishments. We added a minibar, which is highly demanded by our target customers. We need to keep investing regularly in order to stay competitive. Concerning marketing expenses, we chose to advertise on weekdays for the customers we targeted, that is to say, transients and groups. We spent a total of $58,000, which represents 5.1% of our sales, and we wanted them to know about our new features in order to improve our positioning. On the other hand, our competitors' behavior did not justify an increase nor a decrease in our rates. The only exception would be for premium rooms, which were underrated in regard to what they represented. Yet, our advertising paid off since our occupancy increased considerably. Afterwards, to match our freshly achieved investment and our advertising going accordingly, we increased our fares. The price elasticity of our customers being low, the decrease in occupancy was proportionally smaller than the increase in ADR, lifting the RevPAR index up. Unfortunately, we meant to promote our hotel by cutting down our rates by $10, along with advertising and investing in refurbishment. Moreover, we added two new services. It sends a mixed signal and is not logical. Therefore, both the ADR index and the occupancy index decreased, bringing the RevPAR index down as well.
225 for July since we expected a higher demand. We then cut them off to 215 to match the end of the group's visit. We slightly increased our rates in the end to 220 to have a return on our recent investments. We invested in two new facilities in July, the lobby kiosk and the tour desk for groups and transients, which will improve our positioning. In August, we decided to invest in the renovation of our lobby and parking. In order to earn customer satisfaction, we kept investing on our refurbishment to remain competitive and added a new retail shop in the hotel. We focused our marketing on direct only at the beginning, then on GDS as well to match our punctual change in our distribution channels ratios. We finished the quarter by operating our usual marketing, advertising specifically our target customers. Differentiating ourselves from our competitors. The price elasticity drops. Our customers are more likely to stay, even if we raise the prices because of our comparative advantage on others. As a result, even if we raised the ADR, the occupancy did not drop as much. There was an increase in the ADR index, a decrease of the occupancy index, and an increase in the RevPAR index. Our quality improved according to the price-value map.
Concerning our pricing strategy, firstly, we analyzed the price-value map and noticed that we were second in terms of quality, but still perceived as a low-priced hotel. Therefore, we decided to increase our prices by $10. This is also explained by the $165,000 investment made during the high season, now ready to be used. Hence, by increasing our prices, we also aim to increase our GOP. Concerning our investing strategy, during the last quarter, we decided to keep our investment expenses quite stable. In fact, we focused our expenses toward the renovation of the front desk and some soft goods redo, such as the lobby and the public areas. We made our decision based on the reputation management report. Concerning our marketing expenses, as we wanted to boost our visibility towards our target market and communicate our recent facilities investment, we decided to increase our marketing expense toward the quarter. It was definitely a smart move to slightly increase our marketing expense up to 8% of our revenue at the end of the year. On one hand, as we increased the prices, our occupancy rate dropped, but on the other hand, our ADR rate skyrocketed and therefore our RevPAR index remained around 105 on a quarterly basis. Moreover, our investment strategy worked very well as we maintained and improved the quality of our facilities as well as shift our price from low to highly perceived. Setting our prices above the average led us to increase our revenue and profit for the last months of operation. In fact, the $70,000 investment from October made us drop our GOP for November. Nevertheless, this investment flourished as the December revenue and GOP went up again. We believe that this result could have been better, but still remained correct for low season operation. Finally, regarding our facilities, it was the first time that we received relevant positive comments from our guests. This was also noticeable in the price map value. Indeed, we finished very well placed.
Part of our strategy was to not accept any RFPs. Indeed, we did not want to risk offering inaccurate rates and therefore lose the difference of profit between transient fares and group rates. Also, even if we did not accept the RFPs, we still wanted to capture the displaced strangers of the hotel that would accept it. That is why, when RFPs were offered, we tried to lower a bit our fares in order to attract even more transients in our own property. During the first quarter, our target market, transients and groups, proved to be less price sensitive than the other segments, especially for small groups. However, we took the bet of making a strategy based on occupancy maximization for the weekends. We settled what we call the $10 policy, lowering the price of the room by $10, regardless of the room type and the distribution channel. We kept that policy up and expanded it. As of the second quarter, the rates were $40 less during the weekends. It was efficient since we attracted customers the competition did not really focus on without investing in anything. Nevertheless, a different procedure focusing on other objectives could have helped us optimize sales.
Following our strategy from the beginning, we have decided to focus and target large and small group. If we have a look at our revenue mix graph, we can clearly see that our revenue streams are mainly generated from the bar standards, large and small group, with a yearly percentage respectively of 26, 13, and 9% overall. We followed our strategy, targeting large and small group during weekdays and leisure guests during weekends. From these figures, we can clearly imply that we have managed to attract both segments targeting in the first place. Concerning our distribution channel management, for the first quarter, we have decided to follow the last year trends at the beginning and ended up with a consequent increase in direct booking, reaching 75% for premium, 80% for bar transient, both for weekend and weekdays. This change is mainly due to the important revenue we've made via direct bookings, and therefore avoiding high commission fees implemented by OTAs and GDS. Indeed, as we can see on this table, the commission fee was 15 and 20% for GDS and OTAs, and a $10 cost per direct booking. The third quarter have a slight change that occurred in July, as we tried to increase the number allocated to GDS and OTA due to high demand season. We thought that more guests would travel and book via GDS and OTAs. However, this slight change doesn't affect our overall performances throughout the entire quarter. Concerning the fourth quarter, we followed the exact same trend as the second one, with still a high percentage allocated to direct bookings for the same reason. However, concerning our rate reduction, we didn't manage to have a proper and consistent strategy in order to capture the most out of it. Therefore, we've decided to leave it more or less the same throughout the entire simulation. We have applied a 10% reduction to premium when booking was below 55% and an increase of our prices by 10% when booking exceeded 85%, both during weekdays and weekends. We also applied a 5% rate reduction for large and small group, as well as qualified guests, in order to boost our bottom line when the occupancy was low. Unfortunately, we didn't manage to grasp the most out of it and left it aside as we were focusing on the actual distribution channel repartition, even though we know it was an important tool that was not to be left aside. It is a mistake we did throughout the entire simulation.
We will now look at the recommendations in the short run. June was the last time the guest rooms were refurbished. Indeed, the reputation of our rooms was at the low at around 52%. Thus, it is imperative for us to renovate standard guest rooms and premium guest rooms in the months to come. Furthermore, our rates have been reasonably high in comparison to the occupancy rates and the average rates of our competitors. Since occupation is at its lowest, we recommend a decrease in the price of the best available rates from 5 to 7% below average. This will allow us to attract more customers during the period of low occupancy. And finally, our results show that we are the third hotel to spend the most on marketing through direct channels. We recommend advertising less on GDS and more on direct channel in the months to come. Now for the recommendations in the long run. We recommend investing in a theme restaurant. This is because we can surely grasp an important part of the market. Indeed, the reputation regarding restaurants of each of our competitors is very low. This is why we will also refurbish our restaurant. Furthermore, we must make sure that our rooms have a soft goods redo before the high season. Now we must continue applying the same pricing strategy as last year. We must keep the room prices just below average price during the low season. However, during the high season, we must try and apply a premium pricing strategy. This is why the majority of facilities must be refurbished before the end of quarter 3. As we want to target the leisure guests even more than last year, we suggest that we enhance our hotel visibility through OTAs. Thus, we will advertise our rooms on OTAs. We will also continue to advertise our rooms through direct channel. We will also apply a push and pull strategy by persuading OTAs to promote our rooms and by motivating our customers to come at our hotel through discounts, promotions, and advertising.